I think we'll get started right now. Hello, my name is Pete Wynn. I'll be your moderator for today. Welcome to today's webinar, Dangerous Dividend Warning Signs, led by Derek Hageman. So I want to remind all of our webinar viewers that AAII is a nonprofit educational group and is not a financial advisor, and thus is not able to give personal advice. Every investor is different. That's why our goal with each broadcast and article is to educate you on how to make better financial decisions. A handout of the presentation is available under the handouts section of the GoToWebinar control panel located on the right-hand side of the screen. If you have questions for our speaker, please submit them using the questions section of your GoToWebinar control panel. I will select questions submitted and read them aloud for the benefit of all watching the broadcast. Questions that are not selected for the broadcast will be reviewed and addressed afterwards. If you experience any issues with the audio or video of the webinar, please consult the instructions on how to change your device's settings or consult GoToWebinar's website for support at www.gotowebinar.com. A friendly reminder that this presentation is being recorded and a replay of the webinar will be available tomorrow on AAII's YouTube channel, along with links to this afternoon's handouts and to some of the resources discussed. The American Association of Individual Investors is an independent nonprofit corporation formed in 1978 for the purpose of assisting individuals in becoming effective managers of their own assets through programs of education, information, and research. Now sit back, relax, and enjoy this live presentation. Take it away, Derek.
Hey, thanks, Pete. I appreciate it. Hello and welcome to our live event. I think it's going to be fun and educational event as we're going to cover dangerous dividend warning signs. My name is Derek Hageman. I'm a financial analyst at AAII and editor of AAII's Dividend Investing service. We really appreciate you joining us for this webinar. As Pete mentioned, as we go along, if you have questions, we will dedicate some time to answering as many as we can. So let's get into it. Let's start here. And when I reference a page, I'm referring to the page number at the bottom of the slides, not the PDF slide number. So just keep that in mind, please, as we go through these. But let's just start on slide page 1. The learning objectives for today's event are to discuss key warning signs a stock's dividend might be at risk, cover some practical examples, and highlight how using a dividend screener or grader can help you identify sustainable dividend-paying stocks. So let's just start with slide page 3. So I wanted to start the presentation by quickly going over the state of the market, and really from a high level. There's always an argument to be made that the stock market is overvalued. So here's just a current sampling of what the bulls and bears might say. The bears would say that the Fed tapering is imminent. There's stubbornly high inflation, and earnings growth has peaked. While bulls could make the argument that some leading indicators like improving unemployment claims and consumer spending are improving, and may argue that corporate earnings will continue to outperform expectations. I know all of you probably have your own opinions, and I'm not here to pick a side, but there are some signs that point to hopefully a favorable outlook, but there definitely will be some volatility. All right, let's go to slide page 4. I called this one State of Dividends. So after a challenging 2020, as you all know, when many companies were forced to cut or suspend dividends, these payments to shareholders have been growing again, which is good news. So the dollar value of dividends paid on companies in the S&P 500 index hit historic levels in the third quarter of 2021 and will likely establish a new record for the full year. Dividends are back. That's what the senior index analyst at S&P Dow Jones Indices, Howard Silverblatt, reported recently. He said S&P 500 dividends are back as record earnings, sales, and margins have allowed companies to get back to returning dividends to shareholders. Larger dividend increases and a lack of cuts produced a record payment to S&P 500 shareholders in the third quarter of 2021. You can see the S&P 500 yearly dividend payments trend on your screen. So you can see that it's generally risen over the last few years. There was a slight dip in 2020 due to the handful, actually there are more than a handful of dividend cuts and suspensions by companies, but we're starting to see growth again. On slide page 5, let's see. So, I mean, corporate America, like I mentioned, is paying out more absolute dollars than ever in dividends, but dividend yields are at a near record low. Because the S&P 500 has performed well this year, I think last time I checked, it was up around 24%. So dividend yields, they're near historic lows at nearly 1.3%. And remember, dividend yield, it's the projected dividend payments for the next 12 months divided by the current stock price. And this number shows in percentage form how much income can be expected relative to the current stock price. So I really like this graph. You can visualize the ups and downs of the S&P 500 dividend yield over a long period. I mean, this goes back to 1880. And the last time yields were this low was in August of 2000, when they hit 1.11%. The yield high of 13.84%. Wow, I'd love to see those days again. I can't believe that. That was reached in June of 1932. And if you look at the whole period from 1880 to now, the median dividend yield is 4.25%. So we're definitely in a low yield environment. Okay, let's move on to slide page 6. So here's a current view of how companies spend their cash flows. They have several options. You know, and despite the dollar value of dividends rising this year, dividends as a percentage of cash flow, they've decreased slightly in recent years. So companies are spending more cash flow on share repurchases and capital expenditures than dividends. All right, slide page 7. So, of course, we can't talk about dividend safety without talking about the impact of the coronavirus pandemic on stocks. The pandemic tested even the most mature and stable firms, with some forced to cut dividend payments. Others have managed to maintain current levels for the time being, but could be forced to make cuts in the future. In the early days, there was definitely a lot of uncertainty in the market, as you recall, and companies were focused on preserving cash. And as we know, there are certain industries that have been winners during the pandemic and some that haven't done so well. We can see that airlines, energy companies, hospitality, and retail were some of the hardest hit areas. These companies acted very quickly to either cut or suspend their dividend payment. And the good news is that some of these companies have restarted their dividend program, but it's been very slow. So we are talking about dangerous dividend warning signs today, and many of these signs are helpful to predict cuts or suspensions. But I have to admit that the pandemic has been unprecedented, and even the best analysis was probably not foolproof to avoid the flood of dividend cuts in early 2020, but I still think they do provide some valuable insight. Okay, let's move on to slide page 8. So the good news is that dividend cuts and suspensions, they are slowing. However, you can see a sampling of companies that still haven't restarted their dividend programs or have recently cut their dividend payments. So you can see Walt Disney, Expedia, Carnival Cruises, Southwest Airlines, and Coty, which is a makeup and beauty firm. And then you have companies that have also cut GE, Healthpeak, and National Cinema Media. All right, let's get into the dividend safety signs and warning flags. This is really the meat of the presentation. There's a lot going on here in this slide, but don't worry. We are going to cover each point over the next few slides. The main takeaway question here is, what signs can you look for that indicate the safety of a company's dividend payment stream? So investors in dividend paying stocks, we typically seek stocks that are paying steadily increasing levels of dividend income and have cash flow and financial resources to continue to pay the dividends. There are a number of financial ratios and indicators you can use to evaluate this. And we're going to cover the most common ones today. So while these safety signs and warning flags are applied at the individual firm level, you should keep in mind that even the most well-managed company can be overwhelmed by changing winds within an industry. When you are evaluating a stock for its dividend payments, you want to make sure you don't lose sight of the bigger picture in terms of the environment in which the firm is operating. It is also important to remember that when you are evaluating a company's dividend safety, that these financial ratios and indicators, they should be used together. It is not the best idea to use only one of the ratios to make a decision. All of them should be used together to form more of a complete picture. And we'll get into that as the presentation continues. Okay, so like I said, let's get into the meat of the presentation here. First, we are going to look at what is the level and quality of payments. We're going to try to answer that question. So dividend-seeking investors need to evaluate the dividend payments themselves, how steady they have been, and how much you are paying for them. Some of the characteristics we evaluate are dividend yield and annual dividend payments. So dividend yields that are significantly above average for the company historically, or that are above average for the industry, that may indicate higher risk. So dividends paid with no interruptions over a significant time period, they're definitely a positive sign. So we want to look at negative signs and positive signs when we're assessing dividend sustainability. So dividends higher than reported annual earnings, that's definitely a warning sign, since this level of payment cannot be sustained over long time periods. Okay, so let's dig into the level and quality of payments by using some examples. We said today that as part of the learning objectives, we'll be looking at practical examples. So here we go. I'll try to have a few for each section. So I included 3 examples to consider when evaluating dividend safety. In the first box, even if I didn't know the company was AT&T, the world's largest telecommunications company, it would have drawn my attention. Its current dividend yield of 8.4% compares to its 5-year average of 5.7% and its 7-year average high of 6.6%. So, Could that lead us to think that there may be a pending dividend cut? We'll get to that in just a second. So a dividend stream, it may be important to you. I know it's important to me as a dividend investor, but a critical question is how much is the market demanding per share by a firm's stock price? So while most companies don't change their dividend payouts frequently, stock prices, as we all know, they do change all day long. So yields must be calculated each time you analyze a stock. Since yield is dividend divided by price, high yields can be the result of either rising dividend payouts or more commonly falling prices. Prices may drop if investors are expecting the dividend to be cut or if they're expecting some other bad news to follow shortly. If the market is correct in this forecast, a high dividend yield indicates high risk. On the other hand, to the extent this perception is incorrect, a high yield may be an indication of value if the company has the resources to turn its fortunes around. What's a high yield, you may ask? Well, dividend yields that are above the average for the stock historically, or that are higher than the industry average, they are a warning sign of risk. But you must look at other indicators to determine if the market has correctly evaluated the risk. So I said that we would get back to AT&T, so let's do that right now. So AT&T, just to be clear, they haven't cut its dividend yet, but they have sent clear signals to the market. So AT&T last increased its dividend in December 2019, and according to AT&T's CFO, he came out on June 15th in an update to shareholders, and he said the company will pay out between $8 billion to $9 billion annually for dividends, and that's approximately 40% to 43% of the $20 billion or more in free cash flow that AT&T is expected to generate once Warner Media has been spun off. So in the first quarter, if we look at the first quarter ended March 31st, 2021, AT&T paid out $3.8 billion in dividends. That's about $15.3 billion on an annualized basis. And based on the midpoint of the company's dividend payout guidance, post-closing in mid-2022, AT&T will reduce its dividend by 45% to an estimated $1.19 per share. So I don't always trust when company management makes a statement about protecting its dividend, because oftentimes they just have to do something to survive. And I've seen too many times after management's been stressing that it's gonna protect its dividend, within a short period of time, they actually cut it. So I don't always tend to believe company management when it keeps pressing protection of the dividend, because really all you have to do is look at the ratios and indicators, and they'll paint the story for you. But when management signals like cut, I think it's nearly a certainty that that will happen. So just be aware that AT&T will be likely to cut its dividend in the probably at the end of the first half of 2022. So of course we don't want this all to be negative. So for the next one, we included an example of a company that has been doing the right thing for years, PepsiCo. PepsiCo has paid a dividend since 1952 and has consecutively increased its payment for 49 years. I mean, that's incredible. So the history of annual dividend payments, I think it provides a good indication of management's commitment to paying dividends. Dividends paid with no interruptions over a significant time period, what it really does is it indicates that a company can keep the payments going even during tough years, and dividend increases during prosperous years with no subsequent decreases are even a more positive sign. So PepsiCo, it's already a dividend aristocrat. So for those that aren't familiar with what a dividend aristocrat is, dividend aristocrats are companies, are S&P 500 companies that have consecutively increased their payments for at least 25 years. But PepsiCo, so not only is it a dividend aristocrat, it is also closing in on the next level of dividend royalty. If it increases its dividend next year, which by all indications it likely will, that will make 50 consecutive years, and it will qualify to be considered a dividend king. I love these names. I mean, whoever came up with these, they're great, but dividend aristocrats and dividend kings, they're good places to start to find companies with high dividend safety. All right, Pete, have any questions come through that we should address now, or should we keep going?
Go ahead and keep going. We do have a couple questions, but I think probably wait till the Q&A section.
Okay, great, thanks. All right, with that then, we'll continue with slide page 13. So now let's talk about dividend coverage. And in this section, we ask ourselves the question, how well are dividends covered? So for this section, we look at the earnings payout ratio, the free cash flow payout ratio, and the dividend coverage ratio. Those are some of the more common ones to determine dividend coverage. So the earnings payout ratio, that's calculated by taking dividends per share divided by earnings per share. It's a measure of how much profit the company is paying out to shareholders in dividends. The free cash flow payout ratio is the percentage of free cash flow per share paid out as dividends. It's a measure of a company's ability to both pay dividends and increase its cash balance. Next, we evaluate a company's dividend coverage ratio, which is a measure of how secure the dividend is based on the company's cash flow. Let's look at a few examples on the next few slides. Just gonna grab a quick drink. All right, so on slide page 14, the dividend payout ratio is, as you know, how much profit the company is passing out to shareholders in dividends. Any ratio above 50% is considered a warning sign, but there are some caveats, so bear with me a second. However, like all ratios, the payout ratio is industry specific. Very stable industries such as utilities have high payout ratios, which is considered normal. They can be upwards of 80, 90%, and as dividend investors, we have no problem with a dividend payout ratio at that level. So it definitely is industry specific. Generally, growth firms, they have lower dividend payout ratios because they retain most of their earnings in order to fund future expansion. And in contrast, more mature or established firms, they tend to have higher payout ratios as their investment possibilities diminish. So again, a 100% payout ratio, that shows a firm that is paying out all of its earnings to shareholders. Figures above 100% indicate that the payout is greater than earnings, a situation then that it cannot continue forever. Negative ratios show that a company is paying out a dividend while losing money. So you can see that on the slide that the Clorox company and International Flavors and Fragrances, they both have elevated payout ratios above 100%. and they are both above their 7-year average levels. So it's just something we'd want to start paying attention to. Dividends that are higher than reported annual earnings, that can be a warning sign that the firm is facing some difficulties. Some firms pay dividends, since firms, very important, since firms pay dividends primarily from earnings. However, strong cash flows can help cover a dividend payment when earnings temporarily drop. So it's important to look at the company's historical earnings payout ratio trend because companies may have a temporary earnings drop. So Procter & Gamble, the consumer goods giant, I think it's a good example to look at. You can see in 2019 that its payout ratio skyrocketed to nearly 200% when its earnings per share dropped from $3.75 in 2018 to $1.45 in 2019. And if memory serves, I think it had something to do with the issues it was having with its Gillette razors business, and it really hurt earnings. But you can see that it was temporary as earnings came roaring back in 2020 and 2021. So just because a company has a high earnings payout ratio one year, it may just be temporary. So I wouldn't jump the gun and say, oh wow, it's near 200%. I gotta sell this stock right away. It's one of those things that's just one of the indicators. We'd want to look globally across several indicators, but it is something you'd want to start paying attention to for sure. Okay, slide page 15. Okay, so I really like this next example with toy manufacturer Mattel. This is one of the better examples of a flashing warning sign about dividend safety. You can see that for 3 straight years, Mattel's payout ratio was above 100%. And not only that, its free cash flow per share, it went negative in 2015 and 2016. So we are only a little bit into this presentation, but I think you would all agree that that trouble was definitely brewing, and a dividend cut may be on its way for Mattel. And that's exactly what happened, and we'll get to that in a moment. But dividends higher than reported annual earnings, they're a warning sign, like I've mentioned. And since this level of payment, it cannot be sustained over a long period of time. So Mattel, it ended up cutting its dividend by 60% in June of 2017. And they cut it from 38 cents per share to 15 cents per share. And why they had to do that is it freed up cash, freed up about $50 million per quarter for Mattel to help pay down debt. I think that was one of their issues that they were having. And to no surprise, the company is no longer paying a dividend, and its share price, it just hit it within the last week or two. It took more than 4 years for the stock price to recover back to its pre-dividend cut levels. So I think that's the Mattel's a good example. You see a lot of red on this slide. A lot of warning signs are flashing here. So moving on to slide page 16, let's look at the next question. So the next question is, can debt be repaid? So heavier debt loads, they saddle a company with required required cash outflows to bondholders who must be paid before dividends can be paid to shareholders. So however, leverage allows a company to grow faster and so may enhance the return on invested capital even while increasing risk. So there is a certain level of debt that's fine. It's okay. We're fine with that because companies raise debt and they can They can take on different projects. So not all debt is bad. It's just when it gets to certain levels, and that's what we do with these debt leverage ratios. Okay, so since too much leverage strains the company's ability to pay the debt back, creditors and dividend investors, they prefer companies with moderate debt levels, more assets relative to debt. It typically cushions a company during negative cash flow periods, and it should allow the company to maintain its dividend payment even during tough times. So here we look at debt, liquidity, and interest coverage ratios. And I just suggest, please read through this slide at your leisure, because I'm just gonna, given the time constraints, I'm just gonna focus on the times interest earn ratio. So let's move to slide page 17. So the times interest earned, or it's also known as the interest coverage ratio, it's the traditional measure of a company's ability to meet its interest payments, and it's calculated by dividing EBIT, which is earnings before interest and taxes, divided by the total interest payable. So time interest earned, it indicates how well a company is able to generate earnings to pay interest on its debt, which, like I mentioned, it must be paid before dividends can be paid out. The larger and more stable the ratio, the lower the risk of the company defaulting. So in addition, the higher this ratio, the more flexibility a company has in being able to meet its financial obligations and have money left over for dividends, expansion, etc. So as this ratio falls, the risk of a company defaulting on its debt obligations increases. A ratio, and this is important, a ratio of less than 1 indicates that a company's current earnings are not high enough to meet their current obligations, meaning that it will need to liquidate assets to make up for the shortfall, find additional funding, or even reduce or eliminate the dividend. So we have an example on the screen here. Let's just take a quick look at Maxar Technologies. It's a space technology company. You can see that its time interest earned ratio was negative in 2017 and 2018. And remember, it is a measure of a company's ability to meet its interest payments. So we're looking for this ratio to equal at least 1. And like we mentioned, the larger and more stable, the better. So the company maintained its dividend even despite this negative times interest earned in 2017 and 2018. It actually maintained its dividend in 2017 and 2018, but Maxar cut its dividend by 96% in February 2019 from $1.13 per share to just 4 cents per share. I mean, ouch. So again, we don't make decisions based on only one indicator, but if we look at other financial ratios besides the times interest earned ratio, we likely would have seen other warning signs flashing. So I think that's a really good example in terms of debt levels and making sure a company can meet its obligations. Okay, so moving on to the next section. So we want to answer the question, what are the long-term trends? So I'm going to cover this section a little bit quickly, but in general, trends, we do this because trends can help you understand if a company's position is improving or deteriorating. So you can spot trends by examining all of the ratios and indicators we've already covered, as well as we can look at earnings, cash flow, and revenues. We can look at them on a year-by-year basis over the last 5 or 10 years. So we're looking for positive values or values that are at least within acceptable ranges. Deteriorating values definitely are a warning sign. So 2 growth ratios that we look at that can help you identify these positive trends are the dividend and earnings growth rates. So slide page 19, again, we want to stay positive here. We wanted to give you some positive and some that aren't so positive, but with United Health Group example, it really illustrates what we're looking for in terms of what strong growth looks like. So you can take a look at that table in your leisure. And we'll move on to the next slide. So I really like this example. So there have been a range of dividend cutters across various industries over the last decade. And some of the biggest dividend cutters are household names, including BP, which is the multinational oil and gas company, General Electric, which is a diversified industrial giant. Well, not in the near term. They've just recently announced that they're going to be breaking the company up into 3 different companies. And then, of course, Lumen Technologies, which was formerly known, you might know it better as its old name, which was CenturyLink, which was ticker CTL, which is an integrated communications firm. So that's just to name a few. But most of these companies exhibited at least one of the following signs before their massive dividend cuts. One of the signs that we've already discussed, a sharply falling share price or a lack of dividend raises over a long period of time. So over the last decade, I'm just going to call it CenturyLink because that's what I'm used to, but it is Lumen Technologies. It was a 2-time dividend cut offender. So in 2013 and 2019. And I think we can learn a lot from this particular company. After it reduced its quarterly dividend from 0.725 cents per share to 54 cents per share in 2013, the stock plunged about 23% in response. And that's typically what can happen, and that's the danger of a dividend cut, is that the market reacts almost instantly to those cuts. So the company, it planned to use its cash flow to repurchase shares and pay down debt, and that's a few of the reasons why that it gave for cutting its dividend. And those share repurchases are one manner of returning cash to shareholders. Doing so, it really lacks the commitment that paying and raising a regular dividend places on a company. So prior to its February 2013 dividend cut announcement, CenturyLink, it was trading with a yield of around 7%. And yields, and we've talked about this, but it's worth repeating, yields that high in that environment, they're usually a sign that the markets are demanding extra compensation in exchange for higher perceived risk. The company's payout ratio was also near, I believe it was near 200% of 2012 full year earnings. So really a sky high level. So shares of CenturyLink, they dropped to their lowest levels since the late 1990s. I mean, that's really the impact of that a dividend cut can have on a company's share price. And after the company slashed its dividend again, it did it by more than half. So it went from 54 cents per share to 25 cents after it reported fourth quarter and full year 2018 results in February of 2019. So before the cut, the company's yield was near 15% at that time. So more than double the second highest yielding stock in the S&P 500 at that time. So the dividend cut, it generated over $1 billion in annual savings to help the company invest in its growth and to pay down debt. And the cut prompted a number of Wall Street analysts to cut their ratings and price targets. So the company, it's really struggled over the years to increase revenue as its legacy business declines and its move into broadband and enterprise solutions business ramp up. It's just been slower than they anticipated. And one of the other things that really hurt the company was the company's debt increased significantly in 2017 after it acquired internet backbone provider Level 3 Communications, and that was in a deal valued at around $34 billion. So you can see that Lumen Technologies, a lot of things were flashing here. You can see the dividend growth rate over a long period of time was negative. You want to compare it to the industry. You can also see earnings growth has been negative for several years, while the industry that it's in had positive earnings growth. Okay, so slide page 21. We wanted to include this slide to illustrate the global way to look at dividend safety. You can see that we evaluated the level and quality of payments, dividend coverage, debt coverage, and long-term trends for Huntington Ingalls Industries and Allstate. And from a dividend safety perspective, these companies look pretty good. And I like this example because you can see that Huntington Ingalls Industries, it doesn't meet one of the debt coverage attributes. So the long-term debt to capital is greater than 50%. You know, typically we're looking for something less than 50%. But despite that fact, it hit all the other indicators. So really, this is just a good example of needing to look at these companies globally. Okay, let's go to this slide page 23. So one of the learning objectives was on how using a dividend screener or grader can help you identify sustainable dividend paying stocks. So we included a few examples that we like to use. So we included one from Seeking Alpha, Morningstar, if you flip ahead in the presentation, and of course, AAII's dividend grader and dividend screener. So you can just flip through these to give you a look. And I'm just going to stay on the Seeking Alpha one for a moment. I really like this website. Lots of good information, lots of grades on lots of different attributes, and you can see the website URL, seekingalpha.com. Definitely worth checking out their website. Lots of good information, not only on dividends, but on earnings, valuation, growth, profitability, etc. So the dividend screener and graders, they consider several important characteristics of dividend paying stocks. They typically use metrics shown to be productive and predictive of strong dividend growth, safety, consistency, and attractive value relative valuations. So oftentimes there are several subcomponents or attributes that go into evaluating these factors and ultimately used to determine the scores and the grades. Dividend screeners, what I like about them, they allow you to filter a dividend paying stock universe or subset to identify stocks that match specific dividend grade filters and or grade ranges, which can help you evaluate dividend paying stocks that meet your income investing needs. And screeners and graders, you know, they're a quick way to kickstart your research and analysis. So yeah, it's just boom, a click of a button. You can see all the grades here. You can see the different components. You can get a good feel as a first pass on whether a company, quite frankly, is worth doing more research on or not. So one note with screeners and graders, it is important to understand the different attributes that make up the grades. So you'll want to know, you can see there that Chevron has a safety grade of C. Well, it's nice, they present all the different attributes below it. You can see how it grades on certain attributes and how that all rolls up into one overall safety grade. So if you go to Seeking Alpha, again, I think it's a great resource. You can see that there are a significant number of variables that comprise its dividend safety grade. Slide page 24. So here's a view from Morningstar Premium Service. It has some basic information on dividends. You know, one thing I like about Morningstar is the stock analysis. They do have dedicated research analysts that follow companies. They give a great overview of the bull thesis of owning a stock. They give you the other side as well. What's the bear thesis? And I think they just really do a good job of covering the different attributes to help you investigate and gain a lot of valuable insight to make a decision. So on slide page 25, you can see that AAII, you know, hey, I think we have some great dividend evaluation tools with the dividend grader and dividend screener. We don't have the time to get into the details of these tools, but if you do go to our website, so AAII.com, if you go under the community section and then go to AAII webinars, you'll find a webinar from November 2020 on the dividend grader and one from August 2021 about the dividend screener. So there are a lot of good tools out there. I think we have some good ones. Seeking Alpha is nice, as well as Morningstar. And I'm sure, you know, a lot of you viewing the presentation today, participating, I'm sure you have some favorite websites as well. I'd love for you to reach out and tell me what you found to be valuable resources and tools in helping you make decisions about dividend paying stocks. On slides 27, 28, and 29, if you are curious, we provided a little background on the dividend investing strategy and service. We included also a special offer to become a subscriber of AAII's Dividend Investing. And I think it's important to note that dividend investing, we seek stocks that have the potential to rise in price and make larger dividend payments in the future, which is a total return strategy. And similar to AAII's mission, the goal of dividend investing is to provide the education and tools necessary to analyze, research, and manage a successful dividend portfolio. So with that, I want to thank you for participating in today's presentation. I added this slide here. If you do have questions or comments, please feel free to contact me by email at dhageman@aaii.com.